First up, IBM. Would you buy it or let things cool off a bit?
Tessa, just last Thursday, I asked the rest of our team, if IBM was trading at a 52-week high, would you notice? Well, not a single one of us actually did notice, but it shouldn't come to a surprise really to anyone because the stock tends to be very defensive in nature. Between the consulting and software business, almost 70% of their revenue, well, it's reoccurring. And if you compare that to a lot of their peers who tend to be more transactional in nature, they're closer to like low single digits in recurring revenue exposure. The struggle I get here is the multiple. It's trading at, say, the same level as a Google, which is definitely going to probably make investors scratch their heads given the growth profile differences between the two companies. The other thing that probably worries me right now is that growth is probably going to start to slow in 23. One, they won't be a beneficiary of the mainframe cycle. And two, their book to bill has been less than one over the last 2 quarters. I think this is going to pressure their free cash flow goal of $35 billion in 2024, though I don't really see the management team throwing the towel in on that target just yet. I admire what Krishna has done as CEO, but I'm on the sidelines here. It's tough for me to own a company with slowing growth next year at a relatively high valuation, even if it's a 5% dividend yield that's safe.
All right, let's move on to O'Reilly. Can they keep it going?
Yeah, I think the one thing that really sticks out here, Tyler, to me is the O'Reilly story is the efficiency in the supply chain. In the auto parts industry, you need to have the right parts in the right place at the right time, which has definitely allowed them to increase their market share against other mom and pop shops, thus consistently beating a lot of their difficult comps really across the board. You then couple those market share gains with pricing power, then you get a company that's able to leverage their margins, which is something that the market is really loving right now. I think the one concern I have here right now is miles driven. What happens to miles driven with higher gas prices and a work from home environment? Well, if you look year to date, miles driven is actually down only 1% versus year to date in 2019. And that's with gas prices, say, maybe 60% higher than where you were 3 years ago. So you're still seeing that the consumer values mobility. They value driving despite obvious headwinds. So I continue to like the stock. I'd probably prefer a Copart over longer periods of time. But if you want a mean valuation, I'd probably go AutoZone, but O'Reilly's still fine.
All right, our final name today is PepsiCo. Would you avoid it? Would you sip it? Or would you guzzle it down?
I'm not sure there, but I'll be honest right now. Staples, they're expensive. They tend to trade at a 20% premium to the market, and they're closer to like a 40% premium right now. And then you look at Pepsi, and it's probably the most expensive house in the most expensive neighborhood, trading close to maybe a 50% premium. I understand that you get a lot of earnings resiliency with 2/3 of their revenue coming from North America. But hey, you know what? Demand inelasticity has really been stellar for them. Just look at this last quarter. Pepsi printed a 16% organic growth profile off of a 6% comp for a staple, benefiting from a 17% rise in price and only a 1% decline in volume. This tells me that consumers, well, they're continuing to pay for what they want. And Pepsi, they sell affordable indulgences. Maybe not the nectar of the gods known as like Busch Light, but, indulgences nonetheless.
Yeah.
Investors just really haven't seen the trade down here to beverages like you have in other household products. This is a safe trade in a safe place. So I'd probably hold it if you owned it right now.
David, nutritionists everywhere are cringing at your use of the word staple with PepsiCo because they don't think it belongs in any pantry.
David, Busch Light.
Yeah, right. Well, occasionally, right? David Wagner, nice to see you. Thank you.